Welcome, traders. Today, we are going deep into the core mechanics that drive stock prices. This isn't just theory, these are the real world dynamics that separate successful traders from the rest. We'll break down four critical concepts: price action basics, market capitalization, bid ask spread, volume, and liquidity. We will start by talking about price action basics. Price action basics. What is price action? Price action is the movement of a financial asset price over time. Like we talk about stocks. We observe the price over a long period of time. We want to understand the behavior of that particular stock or groups of stocks over a period of time. Now, let's look at the core principles of price actions. Core principles of price action. Number one, we talk about supply and demand. Supply and demand. Now, when prices move up, it means that more people are interested in a particular asset. A good example, let's say the price of Access Bank shares suddenly went up. It means that more people are interested in Access Bank. It means more people are seeking to buy into the vision of Access Bank. Then we call it demand. Then when people are selling the stocks, they are selling their shares. It means that they are no longer interested in that brand. They are no longer interested in Access Bank. So the price of the share comes down. Now, we also look at price action. We study price action in charts. We study price actions in action in chart using the charts. Now, traders use price charts to visualize this movement, and the common one is line charts, bar charts, candlestick. The most common is the candlestick charts. We use the candlestick chart to visualize the price changes over time. We can see what happened 5 years ago. We can study the trend of 5 years ago using the charts. We can understand the financial position, the profits, how people were buying and selling the shares of a company over time. In 2008, a lot of people were buying the shares. Something happened in 2016. There were less demand for their shares. From there, we can make a lot of dynamic decisions. When we dive deep into the past trends, when we understand the past of an organization, it can help us make well-informed financial decision. If we are to invest our funds into the organization or not. Price actions helps us understand the price movement over time, the demand over time, the supply over time. Now, also we have pattern and trends. By looking at the chart, you can spot trends like prices consistently falling or rising. I just mentioned it not quite long. Talk about patterns, the shape of formations that indicate what might happen next. So when we understand the past, we can somewhat not that accurate, but predict the picture to an extent. We can predict the future to an extent. Once we understand the past trends, the past traditions, we can in a way predict what will happen next. We can in a way predict what will happen next. We can understand what might happen next. We can predict, and sometimes our predictions sometimes wins, and that's what we call trading. When you trade, you are basically predicting by choosing from the experience of the past or the event of the past, believing that there might be a reoccurrence of past events or trends. Now, let's talk about market capitalization. Market capitalization. What is market capitalization? Now, when we talk about market capitalization, we or market cap in short, we talk about the total value of a company shares or stocks. Now, it's like a price tag on the entire company, giving investors an idea of how much the company is worth in the stock market. Let's talk about how it's being calculated. We calculate the market cap by multiplying current share price with the total outstanding shares, total number of outstanding shares. Now, a good example is if a company has 10 million shares and each share is worth 50 naira, the market cap is 10 million multiplied by 50, which is going to give us 500 million. Now, let's look into some market cap of some brands, some organizations listed on the Nigeria Exchange Group. Let's take a look into Access Holding PLC. This is the Nigerian Exchange Group website. Here you get access to data of organizations, stock data of all organizations listed on the exchange. Now, this is the Access Bank Holdings. Their stock price, or the share price is 23 naira. Today it has went up 1.77%. Now, that's on the main purpose. Let's look into their market cap. Alright, this is the market cap. This is the market cap. Now, this is the outstanding shares. Now, we want to use the calculator. Let me for calculator. Now, let's look into the calculation. This market cap. I want to look at the market cap and how they got the market cap. Now, don't forget the formula. Market cap, share price multiplied by the outstanding shares. So we copy this, which is the share price, and check a calculator app. Can paste it there. Multiply by the stock. The share price is 23 naira. Multiply by 23 naira. We have 817 billion. You can see we have the exact. You can see we have the exact figure here. So this is how we get the market cap of every organization. If I should check another one, let's check Tantalizer. Their share price is 1 naira 9 kobo. Now let's look at their outstanding shares. This is the outstanding shares. Copy it, go back to my calculator, Ctrl V to my calculator, multiply by 1.09. So give us the same figure here, the same figure that we have here. So this is how we calculate. This is how we understand. We know the market cap of every organization. We multiply the share price by the outstanding shares. That will give us the market cap. However, market cap is divided into three categories. We have the large cap. These are organizations that are above 1 trillion naira. They have high shares, high market share. There's a lot of people that knows the organization, and they are very stable. Now we are going to look into some examples. One good example is Dangote Cement. It's a large organization. It has large share in the market. There is high value for the share. It costs more to acquire its shares. We look into Tesla. We look into Amazon. We look into Apple. These are large cap organizations. These are large cap shares. This as a result of a lot of people, the attention of a lot of people. A lot of people believed in the organization, so they give their money to the organization. They invest in the organization. So they have access to large funds. They can do a lot of things. They have more money to work with. They have more money to acquire and improve the organization. So their incomes are predictable, easily predictable, and there's a lot of trust. And these are large market cap. We have the mid market cap. The mid market cap, the organizations that are below 1 trillion naira. They are growing nicely. They are stable, and it's more interesting for people that believes in long time vision. That's long time vision. People that can stay with the organization for 2 or 5 years, 10 years. People that sees vision into the organization are people that mostly buy into the stocks of the mid cap organizations, because they are growing well. Their records so far has been amazing. Recently, Geregu Power was still at the mid cap stage, uh, and but right now we can capitalize them. We can categorize them under large cap because they are over 1 trillion naira right now. Recently, I think about 6 months ago, they haven't achieved such milestone. I think 6 months or 1 year ago, they haven't achieved that milestone. But those who believed in them back then, when their share price was being sold at 10 naira, let's say 10 naira per shares, those who invested heavily in them and believed in their long time vision would enjoy the kind of growth Gerugu Power exhibited within a couple of years, or a year from now, from 2023 to 2024. There was massive growth from the organization, a staggering growth from the organization. So those who invested when their share price was little, was low, was small, those are the people that enjoys more benefit from the organization. So if I see a mid-cap organization, I want to look into the company financials. I want to look into their vision. And sometimes I basically love to join these mid-cap organizations, so that, because I know that they are stable, the tendency of losing all my money is possible, but it's lower. The probability is lower, and it's interesting growing with them. It's more interesting growing with them. So if I'm investing 5 million naira into a company, or 10 million naira into a company, and I'm leaving this 10 million naira for a period of 20 years, 30 years, I want to see what my money can do for me. I'm growing my money with them. My money will compound consistently for that period that I'm holding my money with them. I might come in with 30 million at the end of 30 years. I'm coming out with 500 million. Depends on the growth of the organization. I might come out with 1 billion naira, depending on the growth of the organization. But it will be exciting growing with an organization. So we have the small capitalization market. We have those who are below 100 billion naira. They are emerging company. They are just coming up. They are companies that they're already breaking barriers. They are getting their attention already. But they are still under 100 billion naira. It has higher risk, because they just come into the market, right? They are not yet standard. They've not made a lot of mistakes. The mid cap organizations has made a lot of mistakes. They've refined themselves. They've learned. They've relearned. They are growing, and they are breaking that barrier of becoming a large cap organization already. So the tendency of them losing money is lower, right? The risk is lower, because at this stage they already know what they are doing. They already understand the market. Then we have this small cap organization. They are emerging companies. It's more riskier to buy into these organizations. We call them penny stocks. They are below 100 billion. So most of them will not be listed on the Nigerian exchange. But there is a place where they get listed. We talk about them when we get to that phase. So the penny stocks, the small cap organizations, are more riskier to buy into. But it's interesting. I could have 10 million naira to invest for a period of 20 years. I could pick 15 million naira. Yeah, 10 million naira. I could pick 7 million naira and invest it into um, mid cap organization for a period of 20 years, and invest 3 million naira into small cap organization for a period of 20 years. For the small cap organization, it's not really guaranteed. You have to be consistent with them. You have to study their growth. You have to follow up their growth. You have to understand the business. You must understand the business before you can even buy any stock. You want to understand what is the company into. If I'm buying into Dangote Sugar, it's because I understand the sugar business. There are times where the business will not be booming. So if I'm investing into a company that produces, let's say, water heater, we will understand that I will understand the business. So I will understand that during the phase, during the period or the season where there is extreme heat, people will not be interested in buying water heater. So as at that moment, the company will not be making much profits. So I will not be expecting too much from them as at that moment. The dividend share they will share during that season might be lower, depending on what they are making. So you have to understand the business before you can take that decision to invest in the organization. Now let's talk about bid ask spread analysis. Now let's talk about the mechanics. What is it really all about? Now when we talk about the bid ask spread, we are talking about the difference between two prices in trading. We are talking about the bid price. We are talking about the asking price or the ask price. Now, what is the bid price? When we say we are bidding for something, it means the highest amount that I as a buyer is willing to pay for the price of a stock. The amount that I believe, the perceived value that I believe will be the best that I can offer for a particular product, for a stock. That's my bid price. When you go to auction houses, they are bidding. Someone mentioned $1 million. Another person mentioned $2 million. You discover that let's say we have 10 bidders in the room. Each bidders mentioned $1 million. Some mentioned they have a range of $1 million to $2 million. All the callers in the room proceed again to the next phase. Some are mentioning $3 million. Some went as high as saying $10 million. Now, by the time we got to that $10 million, you discover that a lot of people will not be responding anymore. You might have why did they stop at that moment? If we were to ask people to judge such scenario, a lot of people say maybe they don't have enough to continue with the auction. We can say that the buyer refuses to proceed with the auction because that is the highest value they can offer for that product. I hope you understand. So bid price is the highest amount a buyer is willing to pay for an asset. Now we have ask price. The ask price is the lowest price a seller is willing to offer, is willing to accept for the same asset. So the difference between the asking price and the bid price is known as spread. The difference between the asking price, the amount someone is willing to sell, and bid price, the amount someone is willing to buy, is what we call spread. Spreads are often invisible costs. The brokers, the market makers, e.g. the brokers, enjoys the profits from the spreads often. They are the one, it's a cost, invisible cost to you. So now we talk about ask price. Say ask price, let's say let's give ourselves a scenario. So the ask price is 50 naira. Now the bidder is willing to, the bid price is willing to sell, willing to buy for as high as 1 naira. So we have to remove the ask price. We have to minus the ask price with the bid price, and that's going to give us 1 naira. So this is the spread. This is the spread. And this spread, this cost, is sometimes invisible. So the market makers are the one that profits from it. Spreads sometimes are a clear indication of liquidity in a stock. For example, if a spread is 1 naira, for example, we can say 1 naira. We can still look at the spread as being fair. That means per shares you purchase, you get to pay 1 naira, invisible cost. We call it spread. Now, if the share price is, for example, is 20 naira per shares, and I have to pay 5 naira as spread, that makes the trade expensive. So I won't want to go for it. That means there is not enough liquidity. There is not enough trading activities. That buyers and sellers are not trading. Maybe a lot of people are not buying the shares of the organization. So that means that makes the spread margin wider. That's too expensive. 5 naira to pay per shares. So we have to calculate the spread every single time. We have to understand the asking price. We have to understand the bidding price. This will help us understand if it is a good buy for us right from the beginning. So, in other words, the lower the spread, the better. The lower the spread, the better. So, we want to look for organizations with lower spreads. Next, we'll talk about volume. Volume. When we refer to volume, we are talking about the total number of stocks being bought and sold. This is a great indication of the company health. High volume means a lot of people are trading it, are buying and selling. A lot of people are interested in the organization. Then we have low volume. Low volume means a lot of people are not interested in the organization. They are not buying. A lot of people are not buying and selling. A lot of people are not buying and selling. We have low activities. Understanding volume can help us make an informed decision about the company health. So volume is one of the key indicators when we talk about price in the stock exchange market. Next, we look into liquidity. Liquidity is all about how easily you can buy or sell an asset without affecting the price too much. High liquidity means there are plenty of buyers and sellers, so you can trade quickly at a fair price. With high liquidity, there are a lot of people buying and selling. High volume implies high liquidity. When there's high volume, we can say we are going to have high liquidity. So you can easily buy and sell. Now, low liquidity means there are fewer buyers and sellers. So it might be harder to trade without significantly moving the price. When there is low liquidity, any sale will lead to the downtrend of the chart. Let's, for example, a company that has about 1 billion naira total liquidity, for example, and there is someone that owns a preferred share to kill it all. Preferred shares. So we talk about preferred shares in the next future. Someone owns a preferred share of about 500 million. If the person sells his shares, it's going to critically affect the chart of the organization, because it's going to show clearly in the chart, because a lot of liquidity were removed. So liquidity helps us trade without affecting the price too much. Now, why does it matter? Fair prices. That's number one thing. In a liquid market, the difference between the bid and the ask price, which is spread, will be small. There will be speed of transactions. When there's enough liquidity in the market, where you want to buy or you want to sell, there are a lot of people waiting to buy. There are a lot of people waiting to sell. So there are a lot of people trading. There are a lot of people buying and selling. So when you join the market to sell, you get to sell faster. When you join the market to buy, there are people that are willing to sell. You get them readily available. Now, let's talk about the relationship between volume and liquidity. We cannot end this module without talking about the relationship between volume and liquidity. High volume usually means high volatility. Liquidity. I mentioned it earlier. If there are a lot of people trading, it's easier to find someone to trade with at a good price. I want to buy access stock shares. There are a lot of people in the market ready to sell to me, so I'm buying. I want to sell the shares. There are a lot of people waiting in the market. They are interested. They want to buy the share. They want to buy more. They want to add more to their portfolio, or new people coming to the market to buy afresh. That's high volume, which also implies high liquidity. We have low volume. Low volume can lead to low liquidity, as I also mentioned it earlier. In an illiquid market, there'll be low volume. There'll be low volume. That means a lot of people. A low volume will lead to an illiquid market. The market will be liquid. So it's important to understand that when you see low volume, there is potential of low liquidity, which might make it harder to buy or sell without affecting the price.